Hello, I'm Stephen Ho, trader and founder of TheStopHunter. Options trading, especially stock options trading, has taken off massively in the last few years. Now, its main barrier to, I suppose, entry is the perceived complexity of the subject, but actually if you do your homework, like you should with anything really, then it's a lot more straightforward than you think. But it is that complexity that will catch you out and cost you a lot of money. So you can't jump straight into such a subject. Now, like I said, it's taken off massively, this area of trading. That's because of software developments, accessibility to these type of markets and platforms, COVID, mindset of the people wanting to get involved, all a number of reasons that have created a interest in the options trading arena. Now in this quick start guide, I'm going to take you through the basics that you need to know straight away to get involved with the options market. There's going to be a few strategies in there as well for you to get you going. Now if you follow me on the YouTube channel, TheStopHunter, then over the coming months we will be publishing a lot more around options trading to get you up to a more advanced level. So I suggest you hit that subscribe button and, you know, like I say, follow me. So with that, let's get on with this quick start guide to options trading. Now we've got a lot to cover off on this quick start guide. Firstly, we're going to look at what options are and why you'd want to trade them, and then you're going to look at how to trade options, and then into the key terminology, the words, the language you need to know straight away. Then 4 basic options trading strategies, then a bit more around the practicality of actually trading options, then a look at 2 more advanced strategies just to whet your appetite a bit on what you can achieve. Then we're going to summarize what we've learned, and then I'm going to throw in a few ideas for how you can take the whole subject further. So firstly, what are options and why would you want to trade them? So before all that, I'm going to answer that question you're probably asking yourselves right now, is why should I learn options from Stephen? Well, the quick answer to that is, well, I've been in trading and risk management in financial markets across the world for over 27 years. I'm one of the leading UK technical analysts, trade my own funds at the moment, but most importantly for this quick start guide, I was a professional options trader, market maker, prop trader, come up with strategies, designed options plays, for many years on a big, financial institution desk. So I'm hoping that with all that experience, I can get you off on the right start in your endeavour into the world of options trading. So what are exactly then options? Now getting back to raw basics, an option is a financial instrument. It's a derivative and it's based on the value of an underlying stock. It could be commodity, it could be currency pair, whatever it is. We're going to be focusing more on the stocks in this example because it's a bit more straightforward and more popular. But like I say, it is based, it's a derivative of an underlying security. Now the options contract built around that underlying asset, whatever market that might be, gives and grants the right but not the obligation to someone to buy or sell an underlying asset at a set price on or before a certain date. Each contract will have a specific expiration date, and we'll dive into expiration dates in a minute. And this is the time which the holder of the option must exercise that contract. And the price of the option is known as the strike price. And how do you trade these? Well, they're typically bought and sold through, especially if we're talking stocks, online retail brokers. And I'm going to be using one that I use to trade options with, to lay out some examples. So if you're familiar with futures, and you could start to see some similarities, i.e. they both can be bought or sold in the future, but I hope you can now see that options have the big difference, and it's all around the option to deliver or take ownership of that underlying asset. So that's really where it gets the name option from, because it simply gives you an option with what you want to do when you come to exercise your option. So I think one of the big takeaways of trading options is that if you're the holder, unlike in say futures, you're not actually required to have to buy or sell the asset, the underlying asset, if you decide actually not to, which is a great advantage to have. Why trade options? For me, it's down to two things. The first one is leverage, and the second one is risk management. Let's have a look at that first one about leverage. Let's use the stock Tesla as our example of how you could potentially use options. Now, Tesla have been coming off since the start of 2022, but your point of view might be that things are about to sort of peter out and turn bullish once more. So in options world, we've got two really basic starter options that we could play here. We could go out and buy the underlying stock, or we could buy a call option. Now there are many variants on the call option that we could use, and as you get more experience you're going to learn it, but for this example I just want to show you the underlying stock versus a call option to show you the power of leverage. So we've got $100,000 in our trading account, and we want to buy 100 shares of Tesla. That is going to cost us an outright $85,045. Now the alternative is to buy a call option. So we've done our homework, and we think that the Tesla stock is no problem going to get past $900, and it can do that quite easily by April the 14th. So we've selected the April the 14th expiry date, the 900 strike, and it's cost us $59.95 per option to do that. Now there's a multiplier factor in there of 100 because it's buying 100 shares, so the actual total cost of that trade is $5,995. So let's see how those two trades, the buying of the 100 shares and the buying of the one option contract, played out. So let's just pretend that the stock price went roaring on up to $1,150-ish. Elon Musk had a great quarter, great results, the price just went booming on upwards. What would have happened to our two trades? Well, our 100 shares that we bought would have made us $30,309, which is a 35.64% return. Very nice indeed. But what about the call option? Well, remember it cost us $59.95 to get into that trade for the one options contract. That price then would have moved to $193.59. Don't forget that multiplier of 100. That then gives us a great profit of $19,359, which is a 322.92% return. That is a massive return on investment compared to the 100 shares. Why? Because we've outlaid so little. That is the power of leverage to the upside, and with options that can also help you to the downside as well. So if our trade, for example, went badly wrong, so the stock price fell to, say, argument's sake, $640-ish, then our shares, 100 shares, would have lost $20,824, which is a 24.49% return loss, whereas our call option would have lost only the amount we paid for it, which was the $5,995. So yes, that's 100% loss, but in this instance it's protected us from a serious downside move. So again, that's helped us in our position. And the other reason why I like options so much, like I said, the second point, it is fantastic for risk management, trade management, controlling a position and shaping a potential outcome. And as you get more experience in options, you'll see that you can do so many different things with them to create different payout profiles on the option strategies you are using. So how do you trade options in the retail world? Well, you're going to have to find yourself a broker. Now, the popular area at the moment is stock options, especially US stock options. So if you're from the US, then it's very easy. You find yourself a broker, and I use First Trade. There's many out there to use broker-wise, but I like First Trade. It gives me all I need. Low fees, costs, plus the markets, like I say, that I want to get involved with. And you can see here, it allows you to create positions. You can see potential losses, potential returns, the risks involved. It's got some great resource to help you in your trading options journey. Now, historically, it's been quite hard to trade US stock options if you're outside the US, but for example, this First Trade account, I'm from the UK and I've got my account open. You can open yourself an international account. The process is really straightforward, and by opening one of these accounts, it's going to give you access to US stocks and options, which are very difficult to normally get your hands on. Now here's the list on the screen. Pause it, see if your country's on it, and you can open yourself a First Trade account. Should be free to do so, and then see if you like it or not. I'll put a link in the description below for you to follow, but as you can see, it covers off a big swathe of the world's countries. The key here though is to get the broker that suits your trading style, you're happy with the platform, what it offers. And I've done some videos on that within the channel, so if you're subscribed, dig through the archives to find those, give you the hints and tips on finding the best broker for you. Now at the moment you still might be very confused with the terminology and language being used. It will all make sense to you, but I'm just going to go over now some key words, terms, phrases that you must know if you want to get on in the world of options. Now, first thing you've got to know with options are the types of options that you are using. Are they either American options or European options? Don't worry about the geographical nature there. They just are trying to relate to two specific types of option type. Now, the American option allows you to exercise on any trading day on or before expiration, whereas a European option only on the expiry date. Now, you're not probably going to have to worry too much about that because most are done the American way, so that gives you the flexibility to trade, but just make sure. Now let's define exactly what expiration is. Well, it's the date at which the option's ability to be exercised ceases, and the expiration date is the last day on which an option can be exercised. Now when selecting our options to trade, need to work out the expiration time, the chance of our strategy idea coming to fruition. Have we given it enough time before that expiration date raises its head? And as you get into understanding the options world more, then you come into contact with something called the Greeks and theta, and that's the cost of holding that option. So the expiration date, very important for many numbers of reasons. It goes into the pricing of the options as well, and the length of time adds or detracts from the value of the option. So what else do we need to know? Now the strike price is another key variable you are going to have to select when picking your options. What is it? Sometimes known as the exercise price. So it's the price at which an asset can be bought or sold by the buyer of a call or put option. So like we saw in our Tesla example back there, we picked the 900 strike. That's because we thought the price could go up through there. Again, that determines and can help determine the price of the option that we pay, and a lot of the other risk variables that go around, putting together an options trade. Now if we take those last two concepts a bit further, that's the expiration date and the strike price. So when the option contract ends and you need to have been making money before this point to realize any benefit out of the options contract, where that price sits relative to the strike price has three names. The first one's in the money, which means your put or call option is making money, i.e. the underlying price is for a call option is greater than the strike price, and for a put option the underlying price is less than the strike price. Then we have out of the money, which means your put or call option is not making money, and for a call option the current price is less than the strike price, and for a put option the current price is greater than the strike price. And you'll also hear the third term, at the money, which means your put or call option is trading around break even, i.e. close to the strike price. Now volatility is very important in options trading, and it's the measure of the fluctuation in the price movement in the asset market you're trading over a period of time, and it's a huge important component to pricing or getting a value for the price of your options contract. Now historical volatility is based on past data. It's a standard deviation of whatever you're trying to trade, based normally on the closing price over a period of time. Now implied volatility is the real key one here, and it's a calculated number derived from normally like options pricing models or the trader themselves making the market, and traders can use this, take advantage of it when there is a big discrepancy often between implied and historical volatility. Now volatility and implied volatility is also used in trying to work out where, for example, the future price of the asset you're looking at might be heading. So it's got many uses, but you've got to be aware of volatility. Now the Greeks are all around risk management and understanding the structure of your options trades or portfolio. Now really, as a newbie to options world, you're only going to start off needing to understand delta, but concepts like theta, which is time to gate and how much it costs you to hold the option, or vega, which is volatility and how that impacts your trading, especially if you were to create strategies you might have heard of like straddles and strangles, all very important. But let's focus in on delta to start with, because when you're buying your first option, you might be thinking or being asked or looking at a chain of options that are based on delta. So what does the delta mean? Well, in simple terms, it's a ratio comparing the change in the price of the asset to the corresponding change in the price of the option. So for example, if we were trading oil and it had a delta value of 0.15, this means that if the underlying stock goes up by $1 per barrel, then the option price will rise 0.15 cents per barrel. So the nearer a delta of 1 you are, you're basically trading the underlying asset. So the question is, where do you buy your delta? Well, we're going to look at that shortly. Now obviously you've got to somehow come up with a price for an option when you're going to buy or sell those options. If you looked on a broker like First Trade, how do they do that? Well, they use options pricing models. You don't really need to know about that too much. You will do eventually as you get more experience, because knowing how they're priced is very useful and can be taken advantage of. Now one of the most common pricing models is the Black Skulls model, and here it is for a call or put. Don't get too scared by the maths. It is a lot more straightforward than you think. What is important is understanding the inputs into the price of the option, and there's 6 basic ones: the current stock price, the strike price, the time to expiration, the volatility of the stock price, the risk-free interest rate, and dividends expected during the life of the option. If you can understand how they work, then how they would impact an options price, then you're in a good place. Now the options multiplier is all about standardization of the marketplace. Now the starter options trader often forgets about the multiplier, but you really got to have that in the back of your mind when calculating potential risks and returns. Now in stocks you will probably almost always come across a multiplier of 100. So what does that mean? That means one options contract controls 100 shares of the underlying stock. Trading options is all about the calls and the puts, but what does that exactly mean? Well, buying a call option gives you a long position in the market, and selling a call option gives you a short position in the market. And then if we flip over to the put option, buying a put option gives you a short position in the market, and selling a put option gives you a long position in the market. So the buyers of the options, whether puts or calls, get the bonus with an options contract that they are not obliged to buy or sell. They get the choice to exercise their right only if they want to, whereas the sellers of the calls are in much more of a dangerous risk position. So really selling options is for the more advanced options trader out there, and they are obliged to buy or sell and has to make good the options contract, and therefore has unlimited risk. So, like I say, don't jump into selling options straight away. Get experience with the basics first. Let's look at 4 basic simple options strategies. Now, don't be put off because they are basic and simple. We've seen how effective a simple strategy is, that call against the outright stock, of Tesla. So these can be as equally as effective and useful in your trading armory, but they're a great place to get you going and to understand how options work. Now the 4 basic strategies are a long call, short call, long put and short put. Now in the world of options trading, the options trader likes to visualize these trades by creating what's known as payoff diagrams, and they better illustrate the potential outcome of the position they're trying to get, and you can put combinations together to see where the profit and loss lies, where the risk will be. Now this is what it looks like generally, and we're going to dig into each one of those individually because these are the 4 key starting strategies. Now remember, I did say selling options is very dangerous, so you're probably going to whittle that down to 2 basic ones to start with, which is the long call and the long put. But we're going to have a look now at those 4. So first up is the long call, and this is a bullish point of view, you want the price of, say, the stock option like Tesla to be going up. Now on the diagram here you can see that tick shape, that red line, right? So the red line there is the price that you've paid, so you've instantly gone into the negative. But as that slope goes upwards and the price increases, you can see your profit increasing. So that red line is the profit and loss line of the trade, and you see the X there, that's the strike price. That's where you're going to start breaking even plus the cost of the option. You can see that as that fades to that line and then pushes on upwards. So what you want for the option here is for the price to go on upwards. If it doesn't go on upwards and it falls under the strike price, you lose the price you paid for the option. Now our second strategy is the short call, and that's the opposite of the long call. It's going to be someone taking the opposite point of view to you. So we flipped that payoff profile chart the other way up. So if you were selling the short call, you'd make money, you get the premium price in your pocket to start with, and what you're hoping for is that the stock price does not increase, because if it does and goes past that strike price, you are going to seriously lose a potential huge amount of cash. So very risky to do, but the opposite of the long call. So next up is the long put. Now this is if your point of view is bearish. Now sometimes it's really hard to short stocks anyway due to borrowing requirements, etc., whereas the long put here allows you a lot easier to go short of the market. And what can we see from the payoff diagram? Well, we can see that from the right hand side this time that the cost to us is set from the beginning, the premium paid, and we really want that price to go downwards and downwards heavily. It's got to get past X, the strike price, for us to break even. As you can see, the P&L line, that red line, starts going up and making us money when the price goes down. Our final starter strategy is the short put, and that's simply just the opposite of the long put. We are selling the put to someone else whose point of view is long, and what do we want to happen is we actually don't want the stock price, say, of Tesla that we looked at earlier to be going down, because if it does, there's an unlimited risk to that downside. It gets through the strike price. As you can see, the profit and loss line, that red line, increases significantly as the price goes down. So from the short put point of view, you know, we are more bullish to neutral the price. So there's the four basic starter strategies, and I've gone through those really because they give you the building blocks to put combinations and ideas together. We'll look at two more, a bit more sophisticated strategies just to give you a taster in a moment. But now let's take a look at how we can actually, you know, maybe in practice trade these options. So you're probably now thinking, how do I come up with these trade ideas? I've got this great new tool called options trading. How do I come up with ideas to actually use options? Well, it's exactly the same way as you would any other style of trading. You've got a point of view, but just remember, options allow you to be more specific. You can be more bullish, less bullish, neutral, bearish, you know, create sideways type trades. The choice is yours. That's the beauty really of options trading. But essentially that point of view that you're going to create is mainly going to come around from three key areas: technical analysis, fundamental analysis, or quantitative analysis. Now you might be already familiar with those, and why not take those ideas that you have there and try applying them and creating option strategies around them? Work out the payoff profiles. Does trading options add more benefit than just trading an outright stock position or a CFD or a spread bet, for example? So like I say, this really is a more advanced process to get really tailored in on the direction of the asset that you are looking at, whilst controlling the risk side of things. So giving you a better starting point from which to take your trading. Now, those 3 ideas that I mentioned, you've got to make options specific. Now, on my YouTube channel and on the website www.TheStopHunter.co.uk, there's a lot of resource out there for you to use. Now, I'm a technical analyst expert. I do a lot of algorithmic trading, very good in the options space, and some of those trade of the day chart ideas that I put out there, you can turn them into options strategies. So why not take a look there and follow us on the YouTube channel. Now, the quantitative side is if you've maybe got more of a mathematical background. It's number crunching, statistics, data. Again, very suitable for today's world in which we live in, with all that information flowing around and available to us to access and use. And then fundamental analysis, it could be something as simple as US stock earnings season. You don't know which way the price is going to go, and as we'll see in a minute, an alternative strategy you might think about using is the straddle, which can make you money in either direction on a very volatile type of stock. So the fundamental analysis is about creating value and understanding what the value is, whether it's undervalued, overvalued, and coming up with a decision. That could be an event, could be, like I say, the earnings, whatever it is. And actually, when you take it back to all 3 ways, you've got to create a structured trading plan. And the thing with options is you have to be pretty precise, know what you're doing. So like I say, follow me on the YouTube channel if you want to learn more about those 3 different methods. We're going to get more and more into them. I also have a Discord channel that I'll put a link in the description below as well, totally free. So sort of like a mini traders club, trying to get a community going there where we'll happily discuss options trading strategies, that sort of thing in there. So now let's just take a look at a typical example of how to actually put on a options trade. So we're back to the broker first trade again, and this time our trade of choice is going to be ExxonMobil for whatever reason, and it's come from one of those 3 methods I touched on there. We think the price of oil is going to go skyrocketing up, and ExxonMobil are going to benefit through their stock price. So from your knowledge already of options, we could either buy the shares, or we could use the leverage and the risk management of maybe buying a call. So what call would we buy in this instance? Well, the first thing you could think of is, remember that term delta? Now, at the money means the price of which we are at now, so that is a delta of half. So you could buy the at the money options, and you're basically buying the stock for half price essentially. Or if you're feeling more ambitious, and this is where the science of options come in, it's about the probability of success. The further and further you go away, then the more unlikely it is that your option strike is going to be hit. So if you go down to a 10 delta option, for example, it's almost getting into the realms of gambling, unless you know something about that stock and that the price is going to move quite heavily to get you in the money. So this is why you need to understand and learn about delta and the nuances of options trading to help you create a typical trading strategy and trade. So this is where having a good broker with the tools, especially if you're new to options trading, can help you out. Now here we are with our ExxonMobil idea. Now you can see here we've got like a simulator of what is going on, and we can pick our strategy through there, and we could go bullish, for example, and we just want that long call just for the moment, keep it simple. And now there's the trade, and remember these terms we've been talking about. We want to buy just one option contract, so that's going to be 100 shares. Remember the word multiplier. Then the expiry date, how long is it going to take to achieve where we think the price could be heading to, and the strike price is that price that we got to get above to make the money. And then we can decide whether we want a call or a put. We obviously want a call. Now at the moment it defaulted to the sort of at the money strike here, and we can change that. We might want to change the date, but we think maybe for this instance April's far enough out for our target. We think it's going to get to about $90. Now if we scroll down through the ladder here of prices, we can actually see that 77.5, there's the delta, it's 52%, so it's virtually at the money, because we know that 0.5 is exactly at the money. So we want to go a bit further out because we're a bit more ambitious on the price, and you can see how much that's in terms of standard deviation moves. So we need a one standard deviation move in the price to get it through into this area, and you can see the cost of the option falling as we go further and further away. And here we are, like I said, into that 10, 11 sort of low delta, which is big risk taking. But we might think with our knowledge that actually, well, look at today in the news, something happens in Ukraine, Russia, and the oil price is going to boost up. There's lack of supply, everyone wants oil all of a sudden again. Then maybe it's not out of the realms of possibility. So for this example, we're going to have the 16 delta. It costs 77 cents per options contract. Remember the multiplier again. So we click on that. You can see there's the premium. That's what we pay. That's what we lose if we go all wrong. And there's our strike price. Cool. And we've created that expiry position. So that's what we want to trade. And then if you actually do this, you hit the trade button. It'll ask you to verify the details, and off you go. It's as simple as that. We can also run the scenario calculator here for our trade. So if we go down to adjusting the price, so currently saying if the price went to 86.48, this would be our return on the call. Okay, so we move that up, and there we go. We've actually got two calls in play here. Here's our 87.5 call, and here's our 75 call. So that's the more at the money one. This is our more ambitious one. And if, for example, the price took off to, let's say, just under $90, then we would make this size of return, 192%, which is pretty monster really in terms of return for what you've outlaid. And you can click again on the actual setup. You can see the cost was $77 for a return of $148. A nice 192% return. But what would happen to the stock price in that same scenario? So here you can see that we bought the 100 shares. Yes, we've made 15.8% and a $1,200 profit. But compare that again to our call option. Yeah, not as much profit, but look at the percentage return that we've got there. The max risk in this trade to the shares is obviously down to zero, 7,750. The max risk on the call was $77. So if it all went wrong, we're only going to lose $77. And we can adjust that price, like I say, to show us that. So as soon as the price has got just below that break-even number. And the further we go down, it's all zero because the options are going to expire worthless. But as that price goes down, notice how the shares still losing value, still losing money. So you've only lost the 77 compared to, the price goes down to 66, which it was back in early 2022. Then you losing $1,000. So typical example there for you of how to start thinking about trading options. Remember I said selling options as a new trader to this arena is pretty dangerous and you need a lot more experience, and I still hold by that. Before you get into selling, writing options, really do your homework and know what you're doing. But there are many option strategies available to you as you build up that progression in the options world, and here I'm going to highlight two simple but effective approaches to certain price situations. Now the first one is called a protective put, and we want to hedge against potential losses and market uncertainty, but still we're overall bullish. So what do we do here? We buy the underlying stock and we buy a put option at a strike price near at the money. Remember what that means, currently. So this then caps the downside, and if the price goes up you lose the premium on your put, but you hope that the underlying move in the stock is far enough to negate that and leave you some profit. And it sort of gives you the shape of a long call option, and this is what the payoff diagram looks like. So taking that, breaking it down, we can see in this example just some random numbers put on there made it up, where we need the price to be going, we need it above $54 to break even. Below that we lose money, but just see how that has created that long call payoff diagram option by actually using two different instruments, the put option and the long stock position. Now our next option position is called the straddle, and we want to buy the straddle. And why do we want to do that? Because we're not sure which way the market is going to go, but we are pretty sure that it is going to go big time one way or the other. It's not going to be flat and quiet. We're expecting market volatility, but like I say, we don't know which way the price is going to go. So what do? We buy the straddle. This is a pure volatility play, and all you need to do is buy a call and a put with the same expiry at the money. Now if the price of what you're trading doesn't move, you lose the premiums on the put and call, but if it does move heavily in one direction or the other, then you will make money. So this is a great strategy to combine with technical analysis. It's great around earnings season, and go around, look for dead markets about to pop, and this is what the payoff diagram looks like for the straddle. See that V shape in either direction between say 32 and 48. We don't make anything, we lose our premiums, but other than that we can actually put on a position that makes us money in either direction. How good is that? So let's take a step back now and do a recap of what we've learned so far. Now we go right back to the start. We actually learned what an options contract was, how that fitted into the financial markets world, the financial instrument that it is, and from that we also worked out why we'd want to use options. Leverage, risk management were the two quick wins there. We then looked how we could trade, especially stock options, which are like I say, increasing massively in popularity through finding a broker, one that's got you the right software, solutions, tools, markets to trade, reliability, all those things. Then from there we went through the terminology, the key words you need to know, things like multipliers, strikes, at the monies, in the monies, out the monies, implied volatility, historical volatility, those sort of things. And then we looked at 4 basic strategies, the key components of building your options trading blocks: the long call, the long put, the short call, the short put. So then from there we took it into actually trading these options. How can we actually put on a trade and what the thinking process is behind that. Then we've touched on a couple of more sophisticated strategies, combinations of options to give you a point of view, how you can come up with these ideas, the 3 different methods, the quantitative, technical analysis, fundamental approaches to launch you into creating payoff profiles, profit and loss profiles that can give you a much more structured approach to your trading and hopefully a more rewarding trading time. Now, options are, as you can see, a great tool to get involved with, but they do require, and I've emphasized this throughout, require you to do your homework, understand about the multipliers, how expiry works. All those sort of things can catch you out and end up costing you a lot of money, so be very careful. It is a high risk tool. It gives you that leverage. Don't abuse it, use it properly, and it can be a great friend of yours. So how do you take this further? Well, it's all about getting your feet wet, dropping yourself in at the deep end. You've got to get the exposure, and through that you will learn far quicker. Now, my suggestion is that you get yourself a broker, especially one like we've seen in this video, the first trade one, where you can play around with potential examples and ideas of options to give you an idea how to structure trades, the costs, the risks, etc. Then you've got to build your trading plan. Really, it's what methods are you going to use: quantitative, fundamental, technical. What time frames are you going to be driven by? Events like earnings. There's so many options, but you've got to define that very thoroughly, very detailed. Stick to it and give it a go. Now, about learning and getting better, why not stick here on the TheStopHunter channel, because we're going to go heavy into options over the next months, years, and why not grow with us? And I've got a lot of experience in this field and I want to share it with you guys out there. And if you want to get into a more immediate discussion group, then why not join us on the TheStopHunter Discord channel, and I'll put a link in the description below for that, where we can happily talk strategy, ideas, share charts, that sort of thing. But like I say, hit the website as well for further resource, www.thestophunter.co.uk. There's a lot of other great free resource out there, and really get stuck into the options learning, and you'll find that it is very rewarding, very exciting financial instrument to be using, very satisfying when it goes in your favor, and also great for the risk management. So I hope you've enjoyed the video, and if you are new to technical analysis, then I do have a great video for you already that takes you from 0 to 60 very quickly in that world, to give you some ideas of what you could do, and then you could apply into the world of trading. So you might just want to watch this video.